Hey, welcome to the podcast, everybody. Thank you for joining me. I'm going to make this kind of quick this evening, but just wanted to get this out to you as we're in kind of one of these. I don't want to overemphasize it or exaggerate, but kind of a critical time where, we're either getting to that point where we're going to bounce and resume, or we may break down and go down further than what we have seen in the past. And so, before we do that, Dow Jones up 91 points today, the S&P up 11. Everything was up anywhere from 0.5% to 1%. Of course, the NASDAQ was the weakest because of Apple, and we'll get to that in just a minute. But in the meantime, here's the S&P 500. Man, we've been going through this 3-day correction. We did have a 90% down day on Friday when we had that 300 and some odd drop in the Dow. Had another down day yesterday, and we come back and have a pretty good day today overall. But the sellers are still active. We didn't see a huge amount of demand, but overall it was a reasonable day to where if you had another day like today, kind of back-to-back, you could probably say that the worst of it is over and we would resume up. We're at that kind of inflection point. But I think what might be possible here, and I'll try to draw this, is that I think we could be setting ourselves up for a head and shoulders pattern. So there's your shoulder. We came up to a higher point. So it's possible that we could, and I'll change the color here, we could come up like this and then head back down again to kind of complete that head and shoulder pattern. So that's something we could do, is look for the market to bounce a little bit only to roll over if something were bigger to happen. So that's one pattern that I'm seeing kind of develop, and we need to watch that. But again, I've talked about over the years that you have to look at each stock differently in regards to the moving averages and so forth. And with the S&P 500, and I always use that one just because it is the broadest index that we have as far as what's quoted the most. Yes, the Dow is what you see on TV, but the S&P is probably the most typical benchmark. But you'll notice here that it's the 100-day moving average that is key, and we came real close to it here recently. So that's the one that I would watch for a significant breakdown. Not if it just crosses it one day. We've had that before. But basically, the 20-day, the 50-day, those have been fairly meaningless. We crossed that on Friday, and everybody made a big deal about it. I think it's the 100-day in the case of the S&P 500. So watch that. We're kind of near some support. A lot of people are kind of looking at this general area of where we are as support. And so again, if we break down, then you will know, hey, something's different. We haven't seen this going back, several months. In fact, the last time you saw something like that was really the fall of 12. So we're talking over 12 months, over a whole year. About a year and a half have we seen something that was, could be more substantial. And again, something that makes you question this whole run, is it over? For right now, we don't have that. So I would say for you that are traders, shorter term, what you're looking for is you're looking to be opportunistic. Where do I buy? Do I buy right here, or am I waiting for something down here? Okay, that's what you're looking for. And I think, again, the next couple of days are going to be critical. It's not that after this type of drop, it's not uncommon to see a 2 to 7 day bounce after a really nasty day like we saw on Friday. And we really had 2 nasty days back to back. So today was a strong day. It just wasn't it wasn't so violent to the upside that it made people question why are they sitting out. And so I think what we're going to see is if we can get another good day tomorrow, solid day, that would be good. But if we just mediocre rise up a little bit, then I'll probably be actually lowering my risk a little bit in some of the portfolios that I manage. But here's the thing. So traders are looking for that opportunistic time. When is enough, and are there stocks out there that have fallen enough we want to take advantage of? That's one strategy, and that's one type of way I manage money. The other way is from a more investing standpoint, and when you're looking at from an investment standpoint, has anything triggered that would make you longer term want to lower and ratchet down your longer term holdings? And I would say, again, zoom out here and take a look and say, does this look like anything but vibration? Not really. Now, we can look at the headlines. We know that there's emerging market currencies going bonkers. We know that there's a lot of. We also know that we're seeing weaker economic data in the last week. It could be just a little weak spot. or it could be something bigger. And then obviously we have the Fed to look forward to, who, if they taper back and don't kind of give any language to say, hey, we may stop this, then the market may not like that and something could change. But having said all that, again, that's all the fundamental kind of the headline news. Just looking at the chart here, is this something that makes you, from a longer term perspective, want to sell? It doesn't me. There's some things that I watch that are getting technically weak, but again, we have to look at the time frames. In the shorter term, they're getting oversold. So again, we could see a bounce, which is setting up for more of a rolling over pattern, something that starts to roll over and go sideways and then starts to head down. But overall, as we've said before, look at the moving averages, how they're still moving up. The shorter ones are at the top, longer ones are at the bottom. We're not seeing anything roll over, but we could start to see that. Then you would start to take action on your more longer term investing positions and maybe get more conservative with those. But for right now, I have not seen any of that. So it's just a matter of saying, let the market play out and see what it's going to give us. But there are things to make money from. Now, real quickly here, before we wrap it up, let's go to Apple. Apple, of course, came out with earnings last night, and I guess for the most part disappointed. And the stock is down 8% today, $44 per share. I drew this line in here. This is kind of I think, support. You can see a heavy volume. It's not exact science, but it's still at this kind of old support where it tried to break above it. Finally did. That became the floor, and now we're kind of sitting in this area. So again, if we start to fail here, then of course you start to look at the 200-day moving average around 485 or so. But look, you still have a stock that what's happening right now is really no different than what we saw back here. When we saw this drop back in 2013, early 2013, when it went from 700 down to sub 400, the whole point of this was growth is slowing. This is a company that's in the hardware business. It's a slow growth area, and we really need some new products. And we really haven't seen anything like that. The discussion has been more about, are they going to hike their dividend? Are they going to do a buyback? And I personally don't want to see management spending their time worrying about how many dividends to pay. I want them to spend their time with R&D, which they're spending a lot on, and inventing new products. Okay, now there was some people today saying, look, this company isn't innovating anymore. And as somebody pointed out on Twitter today, you're sitting there watching a movie on a 4-ounce plate of glass. I think that's a company that's doing plenty of innovating. So we're not worried about Apple innovating. It's just, is it enough to wow investors and the public to say, yeah, I have to go to the store, B, I have to go buy something, and C, then I'm going to go buy their stock. So it's lost some of that luster, and overall the growth rate of Apple has been flat. So it's just I think it's more of a dead money stock. But do you mind owning a stock that's a $500 billion company with as much cash as they have, generating a bunch of cash, and has all these options available to them to purchase growth? They can go acquire growth. They can invent something. They can pay a bigger dividend. They could double or triple the dividend if they wanted to, and yet you're still getting a PE ratio of 13 or 14. Yes, it could come down further. It could go down to $400 again. But for me, it's a stock that I've owned for a long time, and today really didn't change my opinion on it. Again, that's a stock that is more of an investment rather than a trading vehicle. There's plenty of other stocks I think that are worthy of a trade other than Apple. So I think it still has a great place in a portfolio. Wouldn't overdo it. It's not the greatest thing since sliced bread, but it's still a good company pound for pound. So would I jump in there today? No, I'd let it stabilize a little bit. But if it can hold this area, then I think it's probably done going down. All right, guys. Have a wonderful day. Stay warm out there, and we will talk to you soon.